Hello, everybody. A very good evening to you, ladies and gentlemen. On behalf of the Bar Association of Sri Lanka, the organizers of this webinar series, I warmly welcome all of you who are joining us online from different parts of the country as well as from different parts of the globe. I would also like to wish all our viewers who are celebrating Deepavali a very happy and a blessed Deepavali. Today is also a very important day of the weekly webinar series conducted by the BSL, as today we are conducting the 25th webinar, and we as a team are happy and proud to have reached this simple milestone. We have had 24 webinars prior to this on a number of topics of extreme importance for the legal fraternity. The BASL, which conducts this webinar series for the continuous professional development of its members, have managed to reach out to its entire membership right across the island and even those who are overseas. So for this 25th webinar, we have a very distinguished panel of experts to share their knowledge and experience on this momentous occasion with us on the topic banking law. To speak to you on banking law and the various aspects of it, we have the following experts who I am pleased to introduce. First of all, I would like to welcome on board and introduce to you this renowned legal luminary, Mr. Kanagiswaran. Dr. Kanagiswaran, President's Counsel, is a barrister at law of Lincoln's Inn, a graduate in law from the University of London, and an advocate of the Supreme Court of Sri Lanka. He has been conferred the degree of Doctor of Laws by the University of Colombo. He has over 54 years of active practice and has held many distinguished posts at numerous institutions, including being a member of the Law Commission of Sri Lanka, Director of the Law and Society Trust and the Institute for the Development of Commercial Law and Practice Arbitration Centre, Colombo, member of the Council of the University of Colombo, and chairman of a number of committees advising on new legislation. He has also served as a lecturer at many educational institutes, including the University of Colombo and the Sri Lanka Law College. We also have with us Mr. Sirikumara Kudagama, attorney at law. Mr. Kudagama is the Director of Legal and Compliance at the Central Bank of Sri Lanka. He has an LLB and an LLM from the University of Colombo, as well as an LLM from the Monash University of Australia. He has held many posts at several public bodies, including being a member of the National Payments Council of Sri Lanka, panelist of the panel of experts appointed under the Payment Devices Frauds Acts of Sri Lanka, and a member of the Financial Stability Committee, Sri Lanka. He also has extensive foreign training experience, both in the banking and financial sector. I would also like to welcome Melody Vikramanayaka, attorney at law. Mrs. Vikramanayaka has over 29 years of experience in the field of corporate, company secretarial, compliance, and banking laws. Mrs. Vikramanayaka is currently the Vice President Legal, heading the legal and corporate sustainability areas at the National Development Bank. She also has gained valuable experience as a lawyer who has served in the Middle East, whilst her career with the bank amounts to 27 years. Next, I would like to welcome and introduce to you Ms. Shahida Pari, Senior State Counsel. She holds an LLB with first-class honours from the London School of Economics and Political Science and is a barrister at law of Gray's Inn, London. She also has a postgraduate degree in civil law from the University of Oxford and a master's in international legal studies, specializing in business law from the Washington College, USA. She was awarded the Commonwealth Scholarship by the Commonwealth Scholarship Commission, UK, and the Hubert H. Humphrey Fellowship by the Fulbright Commission, USA. She also completed the practice and procedure examination on international commercial arbitration conducted by the Chartered Institute of Arbitrators, UK. Her principal areas of practice are in the fields of civil law, including fundamental rights, public law, commercial law, financial law, and tax law, and she appears as counsel in judicial proceedings as well as local and international arbitrations and mediation proceedings. She has served at several institutions, including being a legal consultant at the Securities and Exchange Commission of Sri Lanka, a member of the Company Law Advisory Commission of Sri Lanka, and a legal advisor of the Central Bank of Sri Lanka. She is also a lecturer at several institutions. Now we move on to introducing to the moderator of today. We have Mr. Keshan Thalgahagoda, attorney at law. Mr. Thalgahagoda has over 20 years of experience. He has an LLM in international trade from the University of Wales and is experienced in the subject as his primary areas of practice includes commercial law, as well as corporate law and litigation. Having introduced to you the well-experienced and skilled panelists of this evening, I believe it is time to start our discussion on banking law. I hope all of you, both panelists and the members of the audience, will have an enjoyable session. Over to you, Keshan. Thank you.
Thank you, Umeyangi, for that introduction. A warm welcome to all those joining us on this webinar through Zoom, YouTube Live, and Facebook Live. Our topic today is banking law. Now, the scope of this topic is very wide, and unfortunately, time constraints do not permit us to delve into the entire gamut of the subject. So rather than biting off more than we can chew, we have identified a few areas to focus on. We will start off with an overview of banking law, touching on the sources of law and the statutory and regulatory framework within which the industry of banking operates. We will then discuss legal aspects of the banker-customer relationship, measures introduced to prevent money laundering, legal issues arising from electronic banking and e-commerce, and finally, the impact of the COVID-19 pandemic on banking. The panel discussion will be followed by a half-hour Q&A session, and I invite you all to send in your questions through the Zoom platform, and our eminent panelists will endeavor to answer them. Questions do not have to be limited to the areas discussed and can relate to any subject coming under the general umbrella of banking law. So without taking any further time, I now invite Sri Lanka's Grand Master of Commercial Law, Mr. K. Kanagiswaran, President's Counsel, to start us off by giving us an overview on the subject. Over to you, sir.
Grand Master, oh, thank you. Good evening, ladies and gentlemen. Happy Deepavali to one and all. As Keshan said, because of time constraints, I will take you through what has been described as an overview of the Companies Act. I'm sorry, of the banking law. The term banking law actually is not capable of any easy or precise definition like that of the law of property, as I learned, or law of obligations or law of dealing. There is in fact no specific branch of the law which can be termed the law of banking in the sense of a set of legal rules that apply exclusively to bankers or is confined only to transaction with the bank. That is important to remember, because you can't go and say off the shelf and take our personal laws. Master will tell you obligation, dealings and all that. However, the text writers have selected certain areas constituting banking law. So banking law consists of a selection from the general body of the law of those principles and rules which in practice have been found to be more applicable when dealing with legal aspects of banking practice. Example, for instance, it has been found that the relationship between a banker and customer, as Shahida will be talking to you on, is that of a debtor and creditor. So debtor creditor is already there, a legal principle in the general law. But the relationship between the banker and customer has been identified as a debtor and creditor. What it means, what it entails, will be spoken to by Shahida. But the Banking Act, which is a regulatory act and doesn't concern with the banking law, so to speak, the Banking Act does define, but it defines only banking business. That is important. It doesn't define banking business. What does it involve? So it is defined as in the following words: as the business of receiving funds from the public through the acceptance of money deposits payable upon demand by check, draft, order, or otherwise, and the use of such funds. So the receipt in that manner and the use of such funds, either in whole or in part, for advances, investments, or any other operation, either authorized by law or by customary banking practices. Customary banking practices are to be seen in decisions of our courts. Of course, what they are, we don't have time to discuss, but these are the sources. So in other words, in any particular area or commercial or business transaction that obviously falls in the day-to-day business of a bank can be categorized as pertaining to banking law. Those of you who practice in the commercial high court know the jurisdiction is based on what they call commercial transactions, and within parentheses, they have defined as including cause of action related to banking. Now, cause of action related to banking is not defined there. So you need to, maybe in a proper case, you can argue a particular cause of action doesn't come within the jurisdiction. So in that, you will have regard to the definition of the banking business. You see, so thus what have been recognized by text writers and the courts of law as constituting banking law. Out of the general law are some of the following, though not exhaustive list of matters I like to refer to. You will, one is relating to negotiable instruments. Negotiable instruments are bills of exchange, checks, promissory notes, etc. Now, checks, remember, can only be handled by licensed banks. It is licensed under the Banking Act, under the Monetary Law Act, can be handled by licensed banks, as it is defined as, quote, a bill of exchange drawn on a bank. So the checks can only be issued by licensed commercial banks. It should be noted that the English law relating to negotiable instruments apply. Why English law, I'll come to later, how it came about. I want to flag this. English law relating to negotiable instruments applies not merely to completed contracts and the results flowing therefrom, but also the requisites of their formation. Now, on this, you will find a nice passage in Veeramanthari's Law of Contracts. If interested, volume 1 at pages 49 to 50. If interested, you can read it up. So when you speak of completed contracts and formation of contract, you naturally fall into the principles of the law of contract, also a source of the banking law, because the very relationship between a banker and the customer is a contract. All legally enforceable obligation can arise only by two ways. One is by agreement between parties, other is by operational law, nothing outside of that. So the principles of contract are embraced within the idea of the banking law. The very relationship between banker and customer is based on contract, and contract law principles are often applicable to solution of banking principles, right? Then laws related to agency, partnerships, companies, and trusts. Trust very much involved in the banking operation. Trusts are often applicable to banking disputes. Agency is important because it will determine the actual authority or the ostensible authority of banks officers in respect of their liability to third parties. And if you are interested to read something about it, you see the judgment in Collins versus Bank of Ceylon in 1984, two Sri Lanka law reports at page 253 that deals with this question of authority or sensible authority. Then we have the law related to carriage of goods by sea, marine insurance, which applies to bankers' documentary credits, letters of credit, bankers' documentary credit. So that's another source of or what we will call banking law. Then laws relating to guarantees. Bank guarantees, bailments. When you give property, your money or something to be kept in safe custody, the services offered by the bank, that is the law of bailment. So bailment also impacts on part of banking law. Bankruptcy or insolvency will be applicable as terminating the banker-customer relationship. You don't think of human beings only, corporations also. Therefore, bankruptcy and insolvency of people. Then conflict of law principles. In fact, I saw there are a couple of questions on internet. That will become because of the globalization is gaining importance, and conflict of law principles will come into area of banking as well. Banking business is several other areas of law. So I want to touch upon the history. Where did this all come from? Now, if one were to ask how this did it all originate, where did these laws come from? There is, in fact, there is no known historical record, now Mahavansa doesn't mention about it, of any banking system in Sri Lanka or under the Portuguese or the Dutch. So always we can blame it on the British. Of course, blame it on the British, because when they came to plant coffee and tea, they brought some of these laws. I am told the first bank to be established in Sri Lanka was the Bank of Kandy in 1828 and survived for about 4 or 5 years. And they introduced the English law on the subject. That is how we come to apply English law. We don't have Roman Dutch law. I'll play the interplay. I'll come to. Keshan, if I'm getting closer to the time limit, tell me, I'll run through. Section 3 of the Civil Law Ordinance, as amended, flag me, or it says, in all questions or issues which may hereafter arise or which may have to be decided in Sri Lanka with respect to the law of partnerships, corporations, banks, and banking, shall principals and agents, carriers by land, life and fire insurance, not motor insurance, not general insurance, life and fire insurance, law to be administered shall be the same as would be administered in England in the like case at the corresponding period if such question or issue arose or had arisen to be decided in England. And through that section 3 of the Civil Law Ordinance, introduction of English law came to be applied to banks and banking in Sri Lanka, like our company law, like our life insurance, agency, all those things are English law. So those of you who wish to know how the English law of banking came to be introduced to the island, I will recommend you read De Costa versus Bank of Ceylon, 1960, the beautiful judgment. De Costa versus Bank of Ceylon, 1969, 72 NLR at page 457. Now you might want to know, how does the Roman Dutch law impact on this? So where the English law does not for any reason apply, or where its application has been exhausted, then Roman Dutch law springs back as the common law of the land. Example, if a judgment is given in favor of a plaintiff in an action on a bill of exchange, check or something like that, and a decree is entered, there is a money due. For that money due, he will have to levy execution and so on. But for instance, the plaintiff creditor agrees to waive that amount. He said, no, okay, I don't want to. Okay, you carry on. I don't want to. Then in law, the consideration that the waiver must be, consideration for that waiver must be decided according to Roman Dutch law principles and not English law principle. Because the original debt due on the check becomes merged with the decree and ceases to exist. And the amount due on the decree, the judgment, is a new one, and therefore it falls outside the embrace of the English law and becomes governed by Roman law. This is a bit complicated area. I don't want to just give you flag these things. This is called the doctrine of merger. I don't want to trouble you too much on that. If you want to read about it, Ramalingam versus Jones, 1939, 40 NLR at 486. So thus, note should be made of the fact that there are many matters that relate to or incidental to banking and checks in Sri Lanka that are governed by English law, not by English law, but by Roman Dutch law. I haven't got the time for it. sometimes question of consideration can be governed by Roman Dutch law and not English law. Another just a final note is on personal laws. You know, Sri Lanka is a multicultural country, and we have different laws of the indigenous people, the Sinhalese, the Muslims, and the Tamils. So as you know, we have the Tesavalame, we have the Kandyan law, and we have the Muslim law. So personal laws may be applicable, quite apart from English law and Roman Dutch law, in respect of transactions because of the peculiarities of those laws. Tesalama, you know, bank won't give a loan to a woman, Tesalama woman, unless husband also signs. There are reasons for it. So all these impact become part and parcel of the law banking in Sri Lanka, law relating. So there is no special body. This is how the general principles of the law are brought in to constitute the banking law or the banking law. So there are a whole 25 or 30 statute laws which impact on the business of banks, and with the banks and banking business. They should also be not like that. So that's a general overview. I think I have just about used up my time. So later on, if you want any questions asked on these specific issues, we'll be happy to deal with it. Thank you very much.
Thank you very much, sir. Thank you. Very illuminating overview. Now, moving on, the relationship with between the banker and the customer is the foundation upon which the banking industry is built and exists. What is the legal nature of this relationship, and what does that entail? To speak about this, we have Senior State Counsel Mrs. Shahida Bari. Over to you, Mrs. Bari. Shahida, you're on mute.
Sorry. Can you see the screen that I'm trying to share?
Not yet, Ms. Bari.
Oh, all right, then I will not share the screen, but I will, because that might take time, I will just start off. With regard to the banker and customer relationship, let me just start off by looking at a bit of history like Mr. Kanagiswaran just did. The banking sector started in the Mesopotamian civilization by lending of seeds. And during the medieval period, you had merchant banks financing the Silk Route. And then in the 17th to the 19th century, you saw the debt, issuing of debt and allowing of deposits developing in the London markets. This also saw a parallel development in the USA. But it was only in the 20th century that the retail banking as we know it actually started. And with it, there was a development of the ATM system and SWIFT system and so on. But the 21st century found a technological revolution where the IT-based systems took over the banker and customer relationship in respect of internet banking, payment and settlement systems, and so on. But what you would notice, if you look at the relationship between the banker and customer throughout the ages, is that very little has changed in terms of legal concept. So if I turn to Sri Lanka, there are two types of banks, as you all know. There are the licensed commercial banks and the licensed specialized banks. In respect of the licensed commercial banks, this is where the retail banking takes place and the dealings with the customers largely take place. And as Mr. Kanagiswaran has explained, the law governing this banking sector is vast, but mostly it is governed by the common law and statute law, which is English common law, as well as the Roman Dutch law and other personal laws. English common law is applicable because the civil law ordinance says so and for no other reason. But the Roman Dutch law will get interwoven depending on the areas specific to that transaction, such as a mortgage, a land, or a personal tesavalame, or so on. So as you know, commercial banks have multiple transactions, like accepting deposits, advancing loans, overdrafts, and so on. But in each and every one of these situations, it is important to ascertain whether there is a relationship that accrues or arises between the banker and the customer. This is a case-by-case analysis because there is no statutory definition as such as to who a customer is. As Mr. Kanagiswaran took pains to explain, the banker-customer relationship is intrinsically a contractual relationship. And therefore, the limitations in the contract law with regard to formation of contracts, such as age of majority, soundness of mind, and so on, will necessarily apply. But the question in terms of the banking context is, when does a person acquire the legal status of a customer of a bank? In terms of old English cases, there was this notion that you had to have a habit of dealing on a regular basis, that there has to be some form of a regular dealing between the bank and customer. But that, in the case of Ladbrokes and Todd, that was discarded. And now it is stated that a bank-customer relationship can arise the moment the bank receives money or the check and agrees to open an account. In fact, in the Woods versus Martin Bank's case, it went even further, and the court held that Woods became a customer merely upon making an investment on the advice of the bank manager, though in fact his account was opened very much later. In the context of modern banking, you will see that the relationship with non-account holders, for example, the credit card holders, bank loans, and so on, sometimes happen even where there is no bank account open. Therefore, as lawyers faced with an issue of whether there's a bank-customer relationship, it is pretty much contextual. You have to look at whether the circumstances of the case justify the position that a bank-customer relationship has arisen. There is old authority in the 1932 case of Servery versus Lloyd, where it was said that the bank-customer relationship is confined to the bank's particular branch where the account was open. But this is considered obiter dictum and not persuasive in the context of wider branch networks. So now if I turn to specific transactions, if I look at deposits, when a customer makes a deposit in a bank, in a deposit account, the bank becomes the debtor and the customer is the creditor. It is important to remember that the bank is not a trustee in this situation. The money that a person deposits in the bank becomes the money and the property of the bank, and it becomes a debt owed by the bank to the depositor. In a current or savings account, therefore, the money, as opposed to a fixed term deposit account, the money becomes repayable only upon demand. And the demand for repayment, of course, has to be made at the branch of the bank where the account is kept, unless there is a contrary agreement. All of these are a multiplicity of principles that are brought together from cases like Foley and Hill, Joachim versus Swift Bank, and our own Bank of Ceylon versus Upali Dias. If we now turn to the overdrafts given by banks to customers, here the relationship flips. The bank becomes the creditor and the customer becomes a debtor. In a recent case, Justice Anil Gunratna looked at this overdraft facility and how the relationship between the banker and customer could arise. This is the case of Aswaduma Tea Manufacturers versus BOC. Justice Anil Gunratna said that an overdraft has to be contractually agreed. This could be agreed by a written request or in an unwritten form. In an unwritten form, this is how it happens. A check may be drawn by the defendant or the customer for an amount, and that will become an offer. When the customer offers the check, and if there are insufficient funds in the current account, the bank can reject it. If the bank rejects the check, then there's no contract. There's no contract for an overdraft. But if the bank goes on to honor the check and executes the customer's pay order, then it is deemed to be an acceptance. Therefore, there's an overdraft agreement between the banker and the customer. And having overdrawn the current account and benefited from the facility, the customer is not permitted to deny liability. The statement of accounts that the customer gets on a regular basis by the bank and the original ledger maintained by the bank is best evidence in terms of this judgment. And therefore, if there's a discrepancy in the monthly statement regarding the overdraft that the customer has taken, he is required to notify the bank immediately. This is also something that the judgment emphasizes. Of course, there are multiple debt recovery statutes, but everybody is aware of the statutes, and therefore, I will not dwell on that. There are situations where the bank, as Mr. Kanagiswaran took pains to mention, can also be an agent of the customer. This happens where, for instance, the bank is collecting a check on behalf of the customer, or there is a collection of dividend on the bills of exchange, and so on. In this situation, the bank, unlike in the previous creditor-debtor relationships, the bank and the customer, in that relationship, there's a duty of care. The bank has to exercise such skill as is generally possessed by a person engaged in a similar business. Here, other common law principles on agency will also apply. Then there are rare occasions where the bank could also be construed as acting as a trustee. So the banker and the customer relationship could be governed by the principles of trust. This is where the customer may have entrusted money to the bank to invest, or the bank is acting in an advisory capacity vis-a-vis the customer. Or there are situations where there could be a misuse of funds and the bank could be construed as being a constructive trustee. Another area where the bank-customer relationship is important is with regard to mortgages, pledges, and liens. As Mr. Kanagiswaran said, the banking law in Sri Lanka is the English law. But when it comes to mortgages, pledges, and liens, in the case of Michel versus Fernando, 1945, it was very clearly stated that it is the Roman Dutch law that applies in these areas. So as far as a lien goes, there is no transfer of property to the bank. And even in a pledge, there is only a delivery of goods to the bank. And with the delivery of goods, only a special property in the goods are transferred. The general property in the goods remain with the bank. However, when it comes to a mortgage, there's a difference. In the English law, in respect of the mortgage, says in respect of mortgages, say that the property in the goods passes to the bank and the customer only has the right of redemption. Whereas in the Roman Dutch law, the mortgagee does not have a right of ownership. The bank, therefore, only has a security interest. So this distinction on English law and Roman Dutch law when it comes to mortgage is really something that will be very important. As you all know, there are multiple statutes that deal with recovery of loans by banks, and we will not dwell on it here, but it will be relevant to consider in the context of banker-customer relationship, the duty of good faith in exercising the power of sale, which for the purpose of the banker-customer relationship is that the bank should act for the proper purpose and with reasonable care to obtain a proper price. Now, the bank and a customer can also have a bail or bailee relationship. This is where the bank acts as a bailee. This happens when you have the custody services like lockers, or you in fact pledge your goods as security in the bank. Here, the bank is liable for safekeeping, but the contractual duty that is imposed on a bank is likely to be somewhat higher than the general professional standards of a bailee. Therefore, the duty of care imposed on a bank in these situations is likely to be quite stringent. Apart from the express terms, the bank also has certain implied terms read into the contract. This is generally the standard terms are that to protect a customer from fraud by bank's agents and a general duty of care to exercise reasonable skill and care in providing services. But it is important to remember that there is no implied duty to act fairly when deciding whether or not to continue to advance funds or extend an on-demand loan facility. So the customer cannot demand that the bank extend their loans. Therefore, the financial management of a customer remains the responsibility of the customer and the customer alone, and one cannot blame the bank for financial mismanagement. Turning to the customer's duties, there are certain duties that the customer also has, but these are limited. These are in the Macmillan's case and the Greenwood's case. That is to exercise due care in drawing checks to prevent fraud, which might cause loss to the bank, and to take due care to disclose forgery to the bank. But this is not considered a duty that is enforceable by the bank, but it only acts as an estoppel in situations where the customer may claim against the bank. There are also other implied duties with new legislation such as money laundering, which Mrs. Sirikumara will deal with. The banker-customer relationship, like any other contractual relationship, will terminate. This will be by agreement, unilaterally by giving notice, or by death. When you talk of termination, it is important to look at the bankruptcy situation. Because as we just discussed, in terms of a current account or a fixed deposit, the banker-customer relationship is that of a debtor and a creditor, and the customer is only owed a debt by the bank. Therefore, as soon as a bank becomes bankrupt, the sums recorded in the account of the customer becomes payable immediately. But one has to remember that this can only be recovered through the regime of bankruptcy in a particular country. You cannot demand it of the bank outside of the bankruptcy process and the priority of claims in the bankruptcy regime. The central bank is only a prudential regulator and not a guarantor or an insurer of deposits. And therefore, this outcry that one generally has that the treasury or the central bank has to repay is actually contrary to the legal risk that a customer takes when a deposit, when he makes a deposit. The public authorities may be liable in public law, but they do not have an obligation to repay the depositors in terms of the contract entered into. I think I have covered more or less the basic concept of the bank-customer relationship, but I would like to leave you with a few points to ponder. One is the fact that the bank-customer relationship is governed by standardized contracts, and there's very little room for negotiation. Are these terms fair? Have we challenged it in terms of unfair contract terms? Then the customs and practice of trade that are implied terms. Are these fair by the customer? How aware is the customer of these implied terms? Then the consumer protection. Financial ombudsman scheme is available in Sri Lanka, but is this enough? I would also invite you to look at the new change in the sale of loans, because you have loan sales, factoring, securitizations, and so on, where in the banks or other financial institutions sell their loans to third parties. Then you find that the customer is no longer dealing with the original bank, but a totally different party. And as a result, what you would expect as a rescheduling of loans or other kind of facilitation that a bank may offer is no longer available to you. We also have today Islamic banking concepts where the banker-customer relationship is quite different. Our laws have not adequately addressed this dynamic in the Islamic banking relationship. Finally, I would like to leave you with the question as to whether in a situation of bankruptcy, we need to rework our law and introduce a special bankruptcy resolution regime for banks. Thank you.
Thank you very much for that, Shahid. It is very, very useful. And I hope our viewers will raise some questions on the areas already covered. I now invite Mr. Sirukumara Kudagama, Director, Legal and Compliance at the Central Bank of Sri Lanka, to speak to us on the prevention of money laundering, as well as legal issues arising from electronic banking and e-commerce, two areas particularly relevant today. Over to you, Mr. Kudagama.
Thank you, Keshan. I'm especially happy to give this contribution after the introduction of Dr. Kanagesaran and the descriptive details given by Shahida. In view of the interest of the preceding two presentations, I would take the electronic banking part first and then go on to prevention of money laundering area. Dr. Kanagesaran very correctly identified that there is a very wide range of things that would come into the concept of banking law. There is no single thing called banking law. As Shahid also dealt with a lot of different aspects and different roles played in the bank-customer relationship. Especially both identified bank-customer relationship as predominantly a contractual relationship, where the customer is supposed to be the creditor and bank is supposed to be the debtor. Therefore, it's a debtor-creditor relationship in that sense. While it is there can be different roles played in this relationship, like that of principal and agent, or trustee and beneficiary, or as bailer versus bailee, whatever. These things can be there. Now, when I deal with this aspect, I would like to refer to one particular section quoted by Mr. Kanagesaran. That is Section 86 of the Banking Act, where the banking business is defined. And the Banking Act also gives a list of activities a bank can carry out. There are in fact two lists. One is pertaining to the licensed commercial banks and the other list pertaining to licensed specialized banks. Now, in none of these lists, there is a reference to electronic banking. Now, banks are supposed to carry out only those things that are there in Schedule 2 or Schedule 4, as the case may be, depending on whether they are a licensed commercial bank or a licensed specialized bank. Now, none of these schedules contain electronic banking. What is the reason? Now, you may have seen banks sometimes keep their branches open on Saturdays and Sundays, and they say that the 7 days banking. Or they might keep the branches open for 24 hours and say 24-hour banking or 365-day banking. Likewise, there can be different forms in which banks and customers engage in banking activities. I would say that electronic banking is again something like that. Now, when the relationship is predominantly contractual, as we discussed earlier, if a contract can be formed electronically, why not banking be performed electronically? Now, for Sri Lankans to enter into contracts, we all know that a contract may be entered into in writing, or it may be even verbal. If it can be in writing or verbal, with the development of the technology and so on, why cannot it be in electronic form? Now, it is possible. But the problem is whether electronic contracts are recognized in Sri Lanka. Now, I would take you back to the Untitled Model Law, which was introduced in 1996, and based on which lot of countries in the world and several regional countries also introduced their laws. Sri Lanka also, I think, endeavored to enact an Electronic Transactions Act at least from year 2000. Finally, we saw the enactment of Electronic Transactions Act in 2006. But I would like to mention at the same time that Central Bank of Sri Lanka introduced RTGS system, which is real-time gross settlement system, and scriptless security settlement system way back in 2002. One might question if the electronic transactions were recognized in Sri Lanka only in 2006. What was the basis on which large value payment systems were introduced by the central bank 3-4 years back in 2002? That the reason, if I may share my screen, I would show you that the Monetary Law Act was amended in 2002, and it allowed the central bank to run certain systems for the fund transfers as well as securities transfers. And in one of those sections, that is section 62A of the Monetary Law Act, subsection 11 says that such transactions shall not be denied legal effect, validity, or enforceability solely on the ground that such transaction is carried out electronically. So we have the protection of law, and that section further goes on to say, if there is a need, the Evidence Special Provisions Act number 14 of 1995 would be the fallback situation to prove that kind of a transaction. Now, having gone through this system for 3-4 years, then we had the Electronic Transactions Act in 2006. After that, at the same time, we got Payment and Settlement Systems Act, which would basically a regulatory legislation on this area. Then Computer Crimes Act, which came in 2007. Payment Devices Act, Payment Devices Frauds Act, which was introduced in 2006. All these things contributed towards enactment, the electronic banking in Sri Lanka from different perspectives. Some were dealing with criminal aspect of certain misdemeanors in banking activities, some dealing with bank-customer relationship, some with large value payment systems, some with regulatory aspects of the banking area. Likewise, there were different statutes coming in. I would like to draw your attention to one particular piece of legislation, that is Electronic Transactions Act. Now, when we were dealing with the bank definition of bank in business, I particularly remember Dr. Kanagesaran was referring to the fact that banks accepting money deposits which are payable on demand. Payable on demand means demand deposits or check-in deposits. How do we normally make a demand on a deposit? That is by way of a check, by way of a bill of exchange. But you would observe that in section 23 of the Electronic Transactions Act, one major area that has been excluded from the application of the Electronic Transactions Act is bills of exchange. There cannot be a bill of exchange in Sri Lanka in electronic form because Electronic Transactions Act does not apply to it. In addition to that, there is this amendment which came in 2017, which amended Electronic Transactions Act in several aspects in line with International Convention on Electronic Communications. Now, in that amendment, there is one other exclusion introduced. That exclusion says interbank payment systems are not covered by the Electronic Transactions Act. So now we have a situation where we have a fairly sophisticated banking system in the country. Those are recognized in law to some extent by the Monetary Law Act, to some extent by the Electronic Transactions Act. Now the Electronic Transactions Act, as it stands today, says interbank payment systems are not covered by this law. Now this particular amendment seems to have been introduced to meet the international requirements coming from the convention. But I would say that this is not a salutary development as far as Sri Lanka is concerned. Reason being, I went through the convention and explanatory notes given in the convention. What they say is, in countries, since the interbank payment systems are generally governed by well-defined regulatory frameworks and laws that would recognize that kind of transactions, there is no need to cover that kind of things in the general electronic transactions law. But for some reason, in Sri Lanka, without checking whether there is a well-defined regulatory framework for recognition framework for interbank transactions, those have been excluded today. That is one thing that I would like to draw your attention. And having said that, I must tell that in view of the electronic banking products. A lot of interactions between the customers and banks have become online interactions, and there are a lot of things that a bank would do without coming to physical contact with the customer would do without coming to physical contact with the bank. Now, in the traditional bank-customer relationship, a lot of things were developed those days, maybe in the 19th century, considering the fact that the ability to become a customer of a bank is something very privileges. Nowadays, it's not the case. Banks have to go behind the customers and get some customers to their businesses, get customers into their businesses. Now, in this scenario, basically customers are no longer Mr. X or Mr. Y. They are just 4-digit number, PIN numbers or something like that. In that environment, there is an inherent risk posed by certain other criminal elements in the society and certain misbehaviors of certain customers. Now, that is very much highlighted in the prevention of money laundering area and combating of financing terrorism area. Now, I would just mention that in 2006, Sri Lanka introduced a package of laws. One is the Prevention of Money Laundering Act number 5 of 2006, together with Financial Transactions Reporting Act number 6 of 2006. These two laws are being administered by the Financial Intelligence Unit of the Central Bank of Sri Lanka. PMLA, Prevention of Money Laundering Act, is basically the substantive law that deals with the subject of money laundering. It defines the section, offense is defined in section 3. There is a rebuttable presumption introduced in section 4. For example, if you can't account for your money, if you can't explain your money and wealth, you might be presumed to be guilty, or presumed to have involved in an unlawful activity, and those activities which would convert the proceeds of such unlawful activity would be considered as the offense of money laundering. Now, it's a very serious criminal offense, and there are a lot of things flowing from that kind of things if you commit that kind of a crime. Now, since the time allocated me seems to have excluded or about to, I'm exhausting the time, I would stop here, basically giving these simple ideas so that the audience may raise whatever the question that you need in this area or any other related area. Thank you.
Thank you very much for that, Mr. Kudagama. The final part of our panel discussion relates to something very, very relevant to the present time frame. Now, the banking industry is the backbone of the economy. And for an economy that is under siege from a relentless pandemic, what is the role that banks must play to prevent a total collapse? To speak to us on this subject, we have Ms. Melody Vikramanayake, Vice President Legal at NDB Bank PLC. Over to you, Mrs. Vikramanayake.
Thank you, Keshan. Good evening to all of you, and happy Deepavali to all those who are celebrating it. Well, I have been given a very vast area of covering COVID-19 and banking, and I'm wondering how to finish it in this short period. Well, I'll try my best. As you all know, COVID-19 is the hot topic at the moment, and all of us have to fit into the new normal, and that is to do our business in the new normal way. And that would also include your banking needs, which has to be done in the new normal way. So ideally, you have to do your banking also digitally, and all banks are gearing up to that extent. But in my presentation, I will not cover the digital strategy or digital way of doing banking, as Mr. Sirikumar has already covered electronic banking. What I will try to focus on is the concessions that have been given to the customers during this difficult period. Now, as you know, the lockdown and the COVID rules have actually affected many businesses around the country and around the world. And with this, even the employees working in those businesses have been severely hampered. And due to that, we are seeing that lots of people cannot repay their facilities. And that is where the banking comes into kind of focus. So in order to provide a solution to this, all central banks around the world, they scramble to see what kind of solutions can be given. And similarly, our central bank also, they started getting very active during this period, and they brought in a whole lot of new regulations during this period. Probably the general public may not know about it also. There were regulations after regulations that were coming in, and the banks had to keep in touch with all of that. Now, in order to understand the legality, now one may ask, okay, the central bank is passing all these regulations. Are we really bound by it? Do the banks really have to follow that? So in order to explain that, we need to see how the central bank works. Now, it's customary for the central bank to issue directions, determinations, circulars, operating instructions, monetary law orders, and letters, and regulations, and so many other kinds of letters, which all flow from the Monetary Law Act number 58 of 1949 and the Banking Act number 30 of 1988. So for a non-banking lawyer, this may seem rather confusing because there are so many regulations which actually you would not even see and you would not even understand. So just to give you a flavor of it, in 2020, since March, there were 10 directions, 10 circulars, 2 monetary law orders, 1 determination, 10 directions under the Foreign Exchange Act, and so many other regulations and operating instructions, many of those that were issued by the central bank, just to name a few. Now, when the central bank issues directions under the Foreign Exchange Act, generally there are gazettes also which accompany those directions. Then in addition to that, it's not only the central bank. Sometimes they have to get the import and export department also involved. And then again, there are certain gazettes that are issued under that department as well. So it's a whole lot of documentation that you have to be familiar with in order to be conversant with all this. So there were lots of foreign exchange and import and export regulations that were brought in. Mainly, we had to curtail our imports during this period on a short-term basis in order to release the pressure on the exchange rate and also to remove the stress on the financial market. So that had to be done, and it was done by certain other markets as well. Well, as the banks, we were constantly in touch with the central bank, and we were through the Sri Lanka Bankers Association also, there was a lot of dialogue, and all these regulations came depending on that. So, I mean, most of it is very, I would say all of it is very practical, because the banks did express their views, and it was understood what the difficulties that the customers do face. So contrary to the customary belief, most of these concessions have to be borne by the banks. Of course, there was this huge stimulus package of 178 billion rupees, I think, as of now, which was infused by the central bank through various loan schemes to the market, which was actually lent to the banks, and the banks on-lent those to the customers. That was called the Renaissance Saubhagya COVID-19 facility. Now, given the magnitude of all these documents and the directions and circulars, and in the interest of time, I would like to just concentrate only on 3 circulars. That is circular number 4, 5, and 10, which talks about the concessions to customers. If we look at these circulars, circular 4 and 5 is actually with regards to, Keshan, can I be seen? I'm not sure whether I can be seen.
You can be seen, Ms. Vikramanayake.
So circular number 4 and 5 is actually issued with regards to banks and also financial institutions, while circular number 10, which was issued just on the 9th of November, is only with regards to banks. Now, if you look at these circulars, we will have to first see what are the eligible sectors to get these concessions. So under the eligible sectors would be tourism, exports, direct and indirect, IT, apparel, tea, spice, plantation, related logistics, and from the latest circular, that is 9th November onwards, even event managers, and there's a very, very wide definition. Other affected sectors were also added in here so that they also can benefit from these concessions. Now, if you look at who actually can benefit, this was more or less for the SME sector. Now, SME sector was defined as having a turnover between 16 million to 750 million per year, but that was changed. Now it is any business which has an annual turnover below 1 billion would qualify as an SME. So under SME, if you are in manufacturing, agriculture, construction, value addition, trading, domestic pharmaceutical supply, then you would fall within these concessions. Now, the 9th November circular also included non-financial services, and it also gave opportunity to individuals who are involved in these sectors. So it is very, very wide now. In addition to that, any self-employed person and individuals, if they can prove that their income was severely hampered or that they lost their jobs during this period, they too would qualify under this. Then also foreign currency earners who are also affected would come under this circular. Now, the main concessions granted in these circulars were a debt moratorium. You must be very familiar with that word now. You must have heard it over and over again. When we say debt moratorium, what we mean is a non-payment of capital and interest for a period of 6 months. Now, you will remember during the Easter Sunday attack, there was a moratorium given to the tourism sector. But that moratorium was only with regards to capital. Now, what is significant here is the moratorium is for capital plus interest. So basically, these whatever the eligible sectors got a moratorium of not paying for 6 months. So just imagine, it's such a wide array of eligible parties, and the banks have to forego their income for 6 months. No interest, no capital payments for 6 months. So it's a huge hit on all the banks. So during this period, what they said was the installment of the customer will not be increased. So because of the moratorium, the tenor of the loan was increased by 6 months. So you had to push it back by 6 months in order to give the concession. That was on the capital, and the interest had to be paid at the end of that. Now, come 9th November, there was a fresh circular which says that this moratorium has been extended from 1st October 2020 to 31st March 2021. So there, it is slightly different. If the customer wants, they can opt to have a shorter period. it is up to the customer. But the concession given there is the customer's capital and interest during this period will be capitalized and it will be converted into a term loan. And that term loan will be payable over a period of 24 months with a concessionary interest rate. However, for OD facilities, this repayment period will be a shorter period, naturally, because it's an OD. It will be 12 months and the interest rate will be 4%. So those are the main things under these circulars. Now, in addition to that, there were so many other concessions that were given on leasing, personal loans, OD facilities, TOD facilities, pawning, trade finance, where these facilities repayment was extended. And there were concessions on the interest. Then there were concessions given on credit cards. Now, there are further concessions given on credit cards in this new circular of 9th November. Then there were given extensions on checks because the checks were maturing. There's an extension given on those checks so that they don't, even if it matures, we can accept those. Then there were concessions on late payment fees. There were concessions on crib reporting. That is usually if you don't pay during this period, we are mandated to inform crib. But that too was changed, and during this period the concessions were granted so that we don't need to report these customers. Even if they don't pay, we don't consider them required to be reported to crib. Then there is a rule on clubbing of NPL. NPL means non-performing loans. Now, say we have granted a few loans to a group of companies, and within the group of companies, say 30% of the outstanding given to several sub-companies is in non-performing status. Then the rule said that if it is more than 30%, then that entire group, even if they are performing, they have to be clubbed as non-performing for the purposes of the bank. Those were rules issued by the central bank. But there too, we have got a concession, which they have said for this period, we don't need to consider that 30% rule, which is also important when it comes to impairment. That is a separate subject altogether. So that is also waived. Now, if you look at the, again, under these circulars, like I told you, the 178 billion rupees were given as new loans, new working capital loans to these customers. So these all came based on certain directions that were issued. So these loans were given at 4% interest, and it came in 3 separate tranches. In addition to that, there were concessions given to the tourism sector. Those came under separate circulars. There were certain concessions given to the construction sector. There was a very complex kind of circular that was drafted where we can lend to this construction sector by giving new kind of security, and the banks also had to give security for that. So those have to be dealt with separately. It cannot be discussed at this forum. But if anyone is interested in knowing that, I can certainly get in touch with you. You have only to let me know, and I will let you know the details of that. But now, as lawyers, all of you will be interested as to what happened to the non-performing clients during this period. Now, the non-performing clients, there were 3 things that happened during this period. One thing is, first thing is, they had to make a request to the banks. Initially, it was 30th April, but that was extended to 15th May 2020. If they were interested in getting some concessions, they had to write to all the banks by 15th May. So there were 3 things that happened. The first thing is, if there was a case in courts, they could go to courts and say, look here, we want to come to some kind of settlement, and then the banks would have to look at that. The second thing is, there were no parate resolutions passed during this period up to 30th September 2020 with regards to these eligible sectors. And the third thing was, if there was a parate resolution passed on one of these customers, the auction was stayed until 30th September 2020. So this was an ideal situation for non-performing customers to actually get in touch with the banks and to try and see what could be done. Now, there was another thing that happened during this period. Again, under these three circulars, there was the option given for reschedulement of loans. Now, why do we say reschedulement? Reschedulement is when you cannot pay your loan and you give further concessions to the customer, either in the tenor or whatever to pay. So there were two things in the rescheduling. Say if the customer has paid more than 50% of his capital on a loan, then what we do is 50% of the unpaid accumulated interest is deferred. It's kept aside. Then the balance capital outstanding, the balance accrued interest, and the future interest is all clubbed together, and it's put together, and you have to reschedule it and give it over, repay over a period of 3 years. Now, if the customer pays it within these 3 years diligently, then the deferred portion which we have kept aside will be waived by the bank. Now, if the customer has paid less than 50% of the capital when they come for reschedulement, then 25% of the accumulated unpaid interest is kept aside and is deferred. Then the balance capital outstanding, balance accrued interest, and the future interest again is clubbed together, and it's rescheduled over a period of 3 years. And again, the same concept, if the customer pays diligently, then that 25% which is deferred will be waived by the bank. So those were the concessions that were granted. There were many more concessions, but I don't think there is enough time for me to actually finish all that.
Yeah.
Of course, I will be happy to take whatever question even later on, if that can be sent separately.
Thank you. Thank you very much. Thank you very much, Mrs. Vikramanayaka. That was very useful, I think, both for customers as well as for lawyers who are called upon to advise their clients in respect of the concessions that have been granted. We will now move on to our question and answer session. We have got a few questions from our viewers on our Zoom platform, and we'll just try to run I don't know whether we'll have time to go through all of the questions, but we'll try to run through as many as possible. This first question, I think I'd like to pose it to Mr. Kanagiswaran and Mrs. Bari. It relates to the applicable law on bank guarantees. Now, I think there are two questions. One is relating to bank guarantees that are issued by banks, and secondly, to personal guarantees that are taken by banks as security for loans and overdraft facilities, etc., that are granted. Now, the question is, what is the law that is applicable to bank guarantees? Is it the English law or Roman Dutch law? And are the two kinds of guarantees treated differently by the law? Mr. Kanagiswaran, sir?
Yes. Bank guarantees are governed by English law because as relating to banks and banking under the civil ordinance, the nature of the guarantee and the obligation of the restricted party, whether it's personal or otherwise, is determined by the content of the guarantee. You know, so I don't think there is a distinction to be drawn between your personal guarantee and the guarantee in respect of anything else. So it's according to the tenor of the instrument, you are bound by the terms of the contractual arrangement from the document that you might call a guarantee. the distinction is between indemnity and a guarantee, but guarantee itself will be governed by what is it that you have undertaken under the terms of the contract of guarantee. So, under Shahida, you have.
No, I agree with you totally, sir. The distinction would arise as to whether it is a security or an on-demand guarantee. If it's an on-demand guarantee, it becomes payable on demand. On the other hand, if the instrument is to be construed as creating a secondary sort of security, in which event then it's a secondary liability. But otherwise, if it's on demand, it's a primary liability, regardless of whether it's private or by a bank.
Thank you, Mr. Kanageshwar and Ms. Bari.
Yes, join in there.
Yes, Ms. Vikramanayaka, please.
Yes, so just going beyond that, say the bank does pay on the bank guarantee, then it becomes a subrogated debt towards the bank from the customer. Just wanted to add that.
Right. The next question we have is, I think this is a jurisdiction issue in terms of the Civil Procedure Code. The question is, can a bank override Section 9 of the CPC in terms of territorial jurisdiction by introducing into an agreement drawn by the bank that the jurisdiction shall be where the bank determines it to be? And will this position be against public policy? And if so, how? I think this is it's a pertinent question because it's a jurisdictional objection that is regularly raised by defendants in money recovery cases. Can any of our panelists venture an answer for that?
When you speak of jurisdiction, there is the jurisdiction vis-a-vis the court, the territorial jurisdiction, namely that the District Court of Colombo, where the territorial jurisdiction, there is one. The other is in respect of a cause of action that can be instituted. It depends on, the contract was made, land is situated, the defendant is resident. So I don't know what do the banks say about. You see, there's a distinction to be drawn between jurisdiction but you might agree as applicable law and forum selection. Whether within Sri Lanka forum selection is done, I don't know. So is there any particular forum selection you can file your action only in Jaffna, not in Colombo? That cannot determine the jurisdiction. It depends on which court you go to, whether any of the indicia for court jurisdiction as against the territorial jurisdiction is applicable. That will determine. Now, there the plaintiff resides or the defendant resides, you can either go to Kandy if the plaintiff is there, or to Jaffna if the defendant is there, or the land is situated elsewhere. But what is it that the jurisdiction is worried about? I mean, you said there are these banks are taking up.
I think the issue arises when a clause is included in the contract. I think it is very relevant in leasing contracts, finance leasing contracts, where the clause is inserted that the courts of Colombo will have jurisdiction, whereas there isn't anything that would grant the court jurisdiction in terms of Section 9 of the CPC. The defendant doesn't reside in Colombo, the contract has not been entered into in Colombo, payment is made in a different branch. So there is nothing in terms of Section 9 that would give jurisdiction, but whether by inserting that clause, the court can be vested with jurisdiction in the absence of anything that would grant jurisdiction in terms of Section 9.
I don't think parties can confer jurisdiction on courts which have limited jurisdiction.
Right. Mrs. Bar?
I think one cannot override a mandatory provision of law. And in view of the fact that if all of these the CPC is a mandatory provision of law, the parties cannot by agreement override the mandatory provision. So if someone can argue that it is not a mandatory provision, then party autonomy might prevail. But in this situation, I think the provision that has been referred to is likely to be construed as a mandatory provision of law, which therefore means that the parties cannot confer jurisdiction on a court other than what is prescribed earlier.
Thank you, Mrs. Bari. Do any of our other panelists have anything to add to that? Right. So let's move on. Then I hope that question was sufficiently answered. I think that answer was quite clear that parties can't confer jurisdiction on a court that otherwise does not have jurisdiction in law. This question is relating to mortgages and condominium properties. I don't know whether, just let me go through the question. Where a developer mortgages a property and gets a loan to put up a condominium property, from the perspective of the property purchaser, is the bank holding the property as a trust? I don't know whether that question is clear, but is that question clear, or is...
I can venture to answer it from what I've understood it as to whether
Yes.
when it is when there's a condominium being built and the builder, the construction company mortgages the property, and then subsequently the flats per se are sold to others, what is the status of the land? Is the land held in trust for those purchases? I think that is the question. And
I think that's the question, yes.
And to me, it seems that the answer would be no, because as far as the bank is concerned, the bank is entering into a regular mortgage relationship with the construction company who is mortgaging the property. And therefore, I think it will be a skewing of the law of mortgage if we say that it is held in trust for the eventual purchasers, unless there's some form of a tripartite agreement. Unless that has been fashioned in such a way that there's a trustee relationship, because bank-customer relationship, as we've all discussed, is a matter of contract. So unless there's a contractual variation, the normal mortgage laws will apply, and as Roman Dutch law is the applicable law vis-a-vis mortgages, the bank and the original customer will have a bank-customer mortgage relationship. Subject to
Yes. Answer that. In addition to what Shahida said, when we lend to the developer, we do take a mortgage over the land, and when there is a sales agreement done, whoever does the sales agreement sees that the land is mortgaged, but the bank does not hold that property in trust for the unit holder. What we do is, actually, when the developer keeps settling us, we release each unit as and when the developer pays us. That is how it usually works.
You know, this loose use of the word trust is causing lots of problem, I think, because in terms of the operation of trust as a matter of law, it has to be in terms of the trust ordinance. That is either in a certain circumstances, law may infer a trust. You see, otherwise it has to be a contractual arrangement. You see, the trust is an obligation, and it's the ownership of property. It doesn't happen because you think that you take it away from me or hold it in trust for me. No, unless there is by law, by implication, by operation of law, trust is imposed. Otherwise, it has to be a contractual arrangement. That is the basic answer, independent of the nature of the transaction said to be trustee. You had to look at the trust ordinance. Outside of the trust ordinance, there's no trust. That's important. People, you got the wrong question, you end up with the wrong answer.
Thank you, Mr. Kanage, sir. Thank you, sir. Thank you. Then, we have a few questions relating to checks. The question is, when a check is accepted electronically, and if it is dishonored later, how do we decide on the place of dishonor to come to a conclusion as to jurisdiction? I think that is the question. Yes, when a check is accepted electronically, I don't know exactly what that means or entails. But the question is whether if it is accepted electronically and it is dishonored later, how would we decide on the place of dishonor for the purposes of jurisdiction? Can any of our panelists venture an answer to that?
Probably I can explain the first part, Keshan. That is, now I think this is a reference where the law allows checks to be presented in electronic form. Now, you know that under the Bills of Exchange Ordinance, the requirement of presentment is there. Now, in the Payment and Settlement Systems Act enacted in 2005, there is a provision which says that where there is a presentation is required, it is always possible to present a check electronically. So these days, what happens is in banks, where they collect checks, when they collect, when someone deposits a check, they don't send the physical check to the clearinghouse, but what they send is only an image of the check. that is legally recognized. When that kind of image is image goes to the clearing house, the clearing takes place using those images. Then if a check gets bounced, check gets returned, that happens based on the that image sent to the clearinghouse. I think the cause of action arises when the check is dishonored. Dishonor in the check, that happens at the point of the paying bank. Paying bank is the bank that says that the check is not payable. So accordingly, jurisdiction need to be decided.
Yeah, the electronic arrangement is interbank arrangement, nothing to do with the customer
right.
and bank.
That's right. I don't think the electronic involvement there affects the jurisdictional issue in terms of where the check is dishonored. That happens at the paying bank.
That is
it's also a connected question, I think. If the Electronic Transactions Act does not apply to bills of exchange, how does it affect electronic signatures on checks and check clearing systems followed by banks using the image clearing system or image recognition system? Sirikumar, if you can take that question.
I think it's a very fair question, because I earlier said that Electronic Transaction Act does not apply to bills of exchange. That's correct. At the same time, Payment and Settlement Systems Act number 28 of 2005 provides that checks can be presented electronically. It doesn't mean that checks can be drawn electronically or something like that, or bills of exchange or checks can be there in electronic form. That is not the case. It's possible that a physically drawn check be presented electronically. That's possible in terms of law.
Thank you. I think that sufficiently answers that question. Yes.
No, may I ask a question of Sirikumar? You know, how can a customer present the check electronically?
No, it's always the bank. The
bank
collecting bank can present the check electronically, not the customer.
So the electronic signatures will not. Sorry, go ahead.
Right. Then there is another question that had been sent to us via WhatsApp earlier. I think it's a very relevant question from the perspective of electronic banking. We know that in Sri Lanka, customers are reluctant to engage in online transactions, online banking, as well as e-commerce transactions. And one of the primary reasons for this concern stems from the apprehension that their data, the data that they share when engaging in electronic banking as well as online e-commerce transactions, the data is not secure. And we know that at present, there is no data protection law in force in Sri Lanka. So the question is, do we have an adequate framework to protect customer data that is used for electronic transactions? Any of our panelists can take that question?
Unless it is done on a voluntary basis, there is no legal compulsion. I don't know whether the banks do it. They must be using it to sell it. Advertisement, hot curry coming, that one coming. I don't know how they get it. Through my bank, NDB and HNB.
Can I answer that question? Yes. Now, if you look at banks, actually, one of the most important things is the customer data. And when anyone joins a bank, even we are given this, we have to sign this pledge saying that we will not disclose any information of our customer. So it's taken very, very seriously by the employees of the bank. So we have this section 77 in the Banking Act also, which says that banking information has to be protected. Because of all these rules, we have put very, very stringent say software in our systems. There are so many firewalls and firewalls and firewalls, which will prevent any penetration of the information. Also, banks do so many stress testing to see that this information cannot be hacked. That is done periodically, and that is also, if I'm not mistaken, must be a regulatory requirement as well. So we have I would say it's a contractual obligation on the part of the bank not to disclose the information and to protect it to the best of its ability. But beyond that, say if the customer side there is a compromise in their computer system, then the bank cannot do anything about it. In that case, I would think the Computer Frauds Act or whatever will come into play, and it will be the general law.
Yes, and I might also add something. As I earlier mentioned, that we also need to think about this functional equivalence. Now, if something is happening physically, it can happen electronically as well. Now, this fear that electronic transactions or electronic banking is prone to a lot of irregularities and data theft and things like that could be there equally in physical banking as well. Bankers are bound by the very serious duty about the confidentiality flowing from common law principles, say Turnier versus National Bank case and so on. And in addition to that, what Melody mentioned is Section 77 of the Banking Act. There is a serious confidentiality, secrecy obligation on the part of the bankers. They are not supposed to divulge customer data except in certain circumstances permitted by law. In addition to that, as you mentioned, Computer Crimes Act is also there. There may be certain situations where provisions of that can be in the Computer Crimes Act could be invoked using the criminal jurisdiction. In addition to that, as you all know, that there is no Data Protection Act in Sri Lanka for the time being, but there is a particular draft law that is being discussed these days that could certainly cover this aspect. Not only that one can't share information unnecessarily, even one can't obtain information unnecessarily. Say even a banker should be in a position to obtain information only for the specific purpose, only sufficient, not otherwise. And in addition to that, as Melody mentioned, banking sector is very well equipped with a lot of technological developments which would preserve the customer data from getting into unnecessary hands.
Thank you, Mr. Sirikumara. I think that the answers given by our panelists covered what was being asked there. Another question. A bank grants a loan on the strength of forged documents, I think, where forged deeds are handed over for the purpose of obtaining a mortgage. What is the recourse or what are the remedies available to a bank? So I think the question is, if the deeds presented for the purposes of the mortgage are forged or fraudulent, and the bank grants a mortgage nonetheless on that forged deed, what is the remedy available to the bank in the event, for example, if the forged deed is declared a nullity? Anyone?
Go ahead, Melody, you can. What I think is, if money passes under a forged deed, whoever is prejudiced by it will have to be able to establish what happened was under a forgery and seek recoupment if it's a money transaction, you see. So as to whether, I don't think there's any obligation apart from checking the ex facie validity of the, if you know whether the notary is alive or dead or something like that, but you take all the regulatory requirements into consideration, prevention of fraud, everything, registration is there, but eventually it turns out the signature is forged or something like that, then the forgery will impact on the transaction concerning the deed that was given, and any damages ensues therefrom. So on the basis of forgery, I guess you have to see whether he's good for the money. I don't know, but then he float away with the money. Thanks, poor
Yes.
bank.
That's right.
Melanie, you want to say something?
Sir, actually, in addition to that, now security is just a part of the loan. It's just to secure us, but the obligation of repayment would not go off. He will still have to pay us. Of course, the security will not be there, but they will have to provide a separate security, and they may have to face the legal channels of going to CID and all. But then he wouldn't escape from paying the loan.
Yes, I think that's I think essentially it's the ancillary transaction that will be struck down. The primary transaction obligations on the primary transaction will remain.
Yeah. In theory.
In theory, whether it is possible to recover it or not in the absence of a mortgage, because very often I think what happens is if it's a forged deed, the man has taken the money and vanished. So practically, I think there'll be issues there. Yes. Right. I think we are running short of time. We may just take one or two more questions. There's a question about companies and entities that grant loans to the public as opposed to accepting deposits. The question is, are institutions or enterprises that grant loans to the general public as a business, are they regulated?
Licensed and regulated.
It depends, I think.
I know that no company can accept deposits unless they have obtained a license from the central bank. But does that apply to a company that grants loans as a part of its business, or does that come under the money lending ordinance?
As far as the regulation is concerned, you are correct that Banking Act as well as the Finance Business Act prevents someone from accepting deposits. That's there. That's a strict prohibition. But as far as the money lending is concerned, as long as a person is giving away loans using his own money, there is no regulation by the central bank. Probably it may come within the money lending ordinance and so on, but not under regulation of the regulatory framework.
But if to add to that, if the concern is arising from the fact that people are sort of accepting deposits and giving out loans and not really getting caught up within the general regulatory framework, the issue would arise as to whether they are carrying out unauthorized finance business. And the analysis of the factual matrix will have to take place in order to ascertain whether they should in fact be brought within the rubric of the law. Because often one finds that people are in fact carrying on under the guise of other forms of financial transactions, in fact, finance business, and it's only after everybody's played out that the regulators realize that there has been unauthorized finance business being carried out.
Shahida, cheat ordinance or something, is it still there, or cheat, they.
Yes.
Oh.
You remember that those days,
Yes. Such dose is given in Schedule 2 of the Banking Act. That is also covered there, but that can, if I'm not mistaken, it's covered in the Banking Act. But as far as I know, non-banking financial institutions are governed by the central bank. But like Sirikumar said, I don't think anyone can collect deposits without being regulated by the central bank.
I think that that's quite clear. To accept deposits, you need to be licensed by the central bank. But as long as you are using your own funds to grant loans, that itself is not regulated. But I think, like Ms. Bari mentioned, there has to be some kind of overview to ensure that this sort of business is not done as a way of sort of circumventing the law against accepting deposits without a license. Yes, I think I don't think we have time to go into all the other questions. We've got many of them. There was a question, there was a request for the circulars pertaining to the COVID-19 reliefs to be shared maybe with the Bar Association, so that the Bar Association can make it available to its membership. I think we can get that done. And anyway, all of these regulations and all of these circulars are available on the central bank website as well. But I think it might be useful. We can certainly speak to the Assistant Secretary and the Assistant Secretary of the Bar Association to see whether we can get these regulations and circulars and directives, make it available through the basl website as well. So we can do that. So thank you. I think that's about all the time we have for today. Thank you very much. I would like to thank our very distinguished panelists, Mr. Kanagiswaran, Mrs. Sirikumar Kudagama, Mrs. Melody Vikramanayake, and Ms. Shahida Bari for an extremely informative discussion on very timely topics. And I would also like to thank the Bar Association, especially the Secretary and the Assistant Secretary of the Association for organizing this webinar. I'm told that this is the 25th webinar of the BASL, and the efforts of all those involved must be appreciated. Sharing of knowledge is an integral and valuable part of any profession, and webinars, given their reach, provide the ideal platform for this. It's one of the few positives, I think, of our bleak times. Finally, a big thank you to all of you who joined this webinar across multiple platforms. We hope you found the discussions helpful, and we are sorry if we couldn't take all of your questions due to the limited time available. So that's about all from me. I wish you all a very pleasant evening and a happy Deepavali to all those who are celebrating. Do stay safe, and remember,